Okay, 5, 4, 3, 2, 1. Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is April the 12th, and we have Brent crude oil closing on Friday down again at 82.79. It was down over 1% on Friday, a sort of continued trend downwards. Let's kick off with Mike Muller, head of Vitol in Asia, on our month in review, Mike, and maybe if we look at the first quarter, we saw Brent crude oil progressively climb the mountain to $90, $5 in January, another $5 in February, another $5 in March. And early April, we sat pretty at above $90 on Brent. And since that day, we've literally stepped down the staircase to now we're knocking on the doors of 80. Your thoughts on that reversal after the first quarter of continuous climb, $15 there or thereabouts through the first quarter. Now the second quarter, we're giving it all up. Why?
Thank you, Sean. Yes, I mean, I guess the geopolitical turbulence that we saw earlier this year is still as is. We still have a recent attack on a Russian refinery, fire into Russian territory just the other day. We still have disruptions in the Gulf of Aden. And we still have great global concern around Gaza. The point, I guess, is that none of these events have severely disrupted supply of actual oil flows. And we've therefore now moved from a Q1, which has the added hype of cold weather and concerns like that, into a Q2 trading window. Indeed, for crude oil, we're already trading into Q3 because the active trading month is now July. We're through the period of uncertainty, which is characterized by refinery turnarounds every springtime. And people are doing their forward stock projections and factoring the latest inputs on the demand side of the equation, where there continues to be concern over Chinese growth rates. So various analysts out there have seen a peaking in the year-on-year demand growth projections. The backdrop is as follows. 2024 is going to go down as one of the years where demand growth year-on-year has been the greatest, possibly one of the top 5 year-on-year demand growth years ever. That said, people had been looking at close to 2 million barrels per day year-on-year growth, and I see consultants easing those numbers off now into the 1.65, 1.8 type range. Still a very big year-on-year growth. And if you dissect what that is, where it's coming from, there's loss in petrochemicals, loss in NGLs. The area where it's been giving back a little is diesel. So I think various people have been looking at the nowcast, the real-time data coming out of Eastern economies, and China in particular, and have seen fit to somewhat taper off their forward demand projections. So that's what's given us a slightly flatter outlook. Now we're still in the low 80s. $82.80 is not a number that too many producing nations will be too upset about. It just happens to be $8, $9 off the recent highs you referred to.
There'll be Christoph Ruhl, Senior Research Scholar, Center on Global Energy Policy at Columbia University. Christoph, they might be too unhappy with low 80s, but they'll be unhappy with the trend that's been happening since early April and when it was going to end. Your thoughts on the reason we've seen this reversal in the second quarter?
The fundamental reason is that there's too much oil in the world. I mean, we have huge spare capacity. Yeah, that's that simple. There's huge spare capacity, production cuts, and all the rest of it, which may or may not be extended. That's one uncertainty factor. And there's continued strong and to many people still surprising shale production growth. And there is, I disagree for once with Mike, I don't think 2024 will go down in history as one of the biggest demand years, or maybe he meant 2023. But 2024 will see a normalization below what we have seen in 23. On the demand side. The shorter term reason is, it seems to me, that's where I agree with Mike, as if this trend, as this kind of cycle, which we're seeing, 3-month cycle for longer than just January now, also through last year, follows pretty much the developments in Gaza. And it picks up when situations tense, when Iran get more involved, when US sanctions are threatened, and it slackens down when peace talks come up, and all the rest of it, all this, the dollar falls, the dollar rises, the Fed does this, the Fed does that, all these other things which oil analysts like to evoke, they are then brought in on the side of what is actually the underlying political outlook, I think, at the moment. And that explains also why these are not really big fluctuations. This is all sort of in a very more or less narrow band in a range where everybody can still live with. There's one more aspect to that, which Mike started. Many of us in the oil patch, we talk about the impact of the economy on oil demand, and that's of course an important thing. It also works sometimes the other way around. So I'm a macro guy by training, and sometimes look at oil demand, what it tells me about the economy, which is what is not yet in the GDP numbers, which are usually just as unreliable and even later than the oil numbers. And what we are seeing, this decline in the demand for diesel. Diesel is the fuel of industry. That is a decline in trucking and in transport, and so on. That indicates a slowing down of particularly the US economy, and one which has already happened in China. And that is a harbinger probably of things to come, which is also now in the latest labor market numbers, namely that the US is starting to get affected by the general sort of deglobalization trends on the one side and by the interest rates on the other side.
Mike, I mean, one of the pillars to this sort of year we're in, and every year you would say, but is the demand outlook from China and Asia as a whole. As you're saying, we're trading the second half, physical contracts and deliveries now with the trading July and so forth. Where is China looking, do you think? The first half, okay, not great, better than maybe was expected. The second half, what's your sort of expected narrative there for China to be the sort of principal pillar of this $80 and for not to go lower?
There's a number of things when you're observing China, and a lot of it obviously is only beginning to come to the surface. There are some sectors that are doing extremely well in China. I mean, petrochemical demand growth. China is commissioning 3 new ethylene crackers, world-scale facilities that are going to demand naphtha import feedstock. That's boosting oil demand. Against the backdrop, of course, of an Asian chemical market that doesn't need that much capacity, and therefore other capacity is being displaced. But if you look at the import statistics, the productivity stats, and the demand numbers inside China, all sectors other than construction are looking reasonably healthy. And the ISM equivalents, the manufacturing indices, are teetering around the small growth area above the 50 index. That said, the construction sector is kind of important because it does impact steel, copper, cement, asphalt, and indirectly, therefore, oil and diesel in particular, as Christoph said. So there is also a component of displacement by other fuels. 2024 is the year where LNG has finally come into the sort of pricing range where it can contest market share with diesel in those segments of road transport where that's possible. And in China, that's a reasonably pronounced sector, gas-fired trucking, gas-fueled trucking. And of course, in maritime sectors where there is a very gradual start to the commissioning of dual fuel vessels in the container sector, the bulker sector, dry bulk, car carriers, and of course tankers as well. It has now been pretty much the norm in places like Singapore for LNG to displace marine fuel, low sulfur fuel oil. Small number still, way less than 1% in Singapore, but it is a start. And this is just a confluence of many factors. But the Chinese government is looking to stimulate the economy and grow that construction sector in particular, but it's doing so more responsibly, I think, and therefore there's no big bang volatile expectation here. It's a more considered approach. And I have many people coming back from China trips saying, "Gosh, those guys really are quite downbeat." Take, for example, the lack of Chinese tourists. If you do a survey of any major tourist destination, such as Thailand or somewhere exotic like the Maldives, the Chinese were the number one tourists in those areas, or Dubai for that matter. They were number one by some margin in some of those nice destinations up until COVID, and they have not returned. There was a failure in China in terms of confidence in the economy and forward income potential, and therefore people are choosing to stay home and spend money on consumables. And one of the reasons they've got less disposable cash is those middle class holiday makers that have invested in second properties have seen that money evaporate, because of course that sector has either seen half-finished projects or money disappear, or the sector simply not having overcapacity and they're not being able to rent out these properties or monetize them by selling them.
Christoph, I'm not sure if it's correlated, but exploration, let's look at it. The first quarter, the oil price recovered, moved up from 75 to 90 through alongside the narrative that Fed cuts were coming soon. And as that expectation faded away, the oil price has also faded away. I wonder your thoughts on that correlation and what that now looks like going forward, if indeed there is correlation to those two things.
Two things, you mean exploration and interest rates, or you mean
No. I mean,
oil price and interest rates?
we'll explore the topic rather than the oil. No, the idea that as the expectation of Fed cuts disappeared, prices have come off. In the first quarter, oil prices rose with the expectation of Fed cuts being imminent, and hence stimulating economic growth, stimulating activity. Oil price climbs on that expectation. Now the opposite has happened over the last 6 weeks, and prices have fallen on oil.
I think there is a link, obviously, but it's an indirect and weak link, and therefore probably when you try to measure it, a very indirect and weak and temporary sort of correlation, which is running through growth expectations. So what we see every time, at least what we saw, now it's getting weaker, but what we saw is every time the Fed uttered hopes or issued hopes that they would soon raise interest rates, markets went up because people expected positive impulse on US growth, the longer term impulse. That's going to be to some extent also reflected in oil prices. But as I said earlier, I think these oil price fluctuations are around a trajectory which was driven over the last months more or less by Gaza and the threat to the Middle East, a little bit by Russia, by geopolitics. Very rare, but I think in this case it's true, because the supply side is very solid and the demand side is, not these discussions are discussions about expectations. They are not very big changes. One thing I think which is important in this context also is obviously China, because oil demand doesn't grow in most places of the world, and China is the big exception. And Mike said something about other people's reports, which I can confirm. When you go to China, it's amazing, the doom and gloom. It's all sort of really, really, really low cost expectations about what's going to happen. To me, that was the reason to think the Chinese problem has bottomed out. Because if it's just a matter of perception, then you can cure it, and they're not, they have the ammunition to extinguish these little fires. And I think when you look at the Chinese numbers now is the time to invest in China if you want to. It is gradually bottoming out and coming back. It is not going to collapse. That, together with the weakening growth and therefore the renewed hope of an interest rate cut and a positive impact on medium long-term US growth, would probably make for a little surprise on the upside, would prevent prices to fall from as much as they should if you just look at the fundamentals of demand and supply. That's quite likely that we see a positive spill over into oil markets from this. But this is of the sort which is very hard to predict. And no, you should not bet on a strict correlation between interest rates and oil prices. That would be too easy.
But just to pick, sorry, Mike.
Sorry, Sean, I can echo what Christoph said there about China. There's certainly more encouragement than I've ever seen in foreign direct investment in China. Various provinces, provincial governments, and city municipalities have targets on attracting investment, and they are really they're being quite open about how this is possibly a unique time for people to bring such investment into China because the conditions are favorable.
But China it's also a time in which, sorry, I was just going to say, Mike, on that point, the news of the weekend just passed that the Biden administration is going to quadruple the customs duty on EVs going into the US. This can't be encouraging for FDI.
China, if I may, has a long-term problem, which is this coming down of very high growth rates based almost exclusively on a rapid pace of industrialization and export growth. Not so much on domestic consumption, not at all on services. Every economy which has gone through that cycle, and all of us have, all of these economies have, will at some point have to convert to services being the driver of the economy, with most of the employment and output coming from service activities. And these, of course, should be sophisticated services, financial technologies, technology, IT services, and so on. And China has always shied away from making that transition because that is by definition almost also a transition from heavy centralized economic planning to totally decentralized decision making. You cannot run a modern IT innovative sector with central planning. It just doesn't work. And they have done that again. And one of the ways out they have found to continue the model of industrialization and related exports is the energy transition, is the production of solar panels, electric batteries, and EVs. And this is where they are. This is a political decision, and this is where China is vulnerable. If the US, if Europe now says, "No, thank you very much. We know you have a huge capacity in EVs. You know you can produce these things forever cheaper than we can, but thank you. We don't want to ruin our own car industries." Then China will get another growth obstacle. But it's one politically inflicted, and until that happens, they have a fair chance to at least stabilize.
On the local market there, Mike, just look, I mean, obviously the FDI issue with big customs duties into America is the point. But I wanted also to look at the deployment of EVs in China that is happening in an accelerated fashion from a demand point of view. Your a colleague, Russell Hardy, said at the FT Summit in Lausanne that he expected peak products demand in China. The quote was, fairly soon. Of course, that's an undefined period of time, but I presume he consulted with his head of Asia before he made that statement. So what does fairly soon mean? And that sort of EV deployment in China for the consumption of products and middle distillates?
Thanks, John. You can assume we all sing from the same hymn sheet, from the same basis of research, which is Mr. Giovanni Serio and his global research team. Yes.
Yes.
No, it is fair to say that whenever you go to China, you see the most broad range of vehicles you'll see anywhere on the planet, and amongst them a whole bunch of brands that you don't see overseas. So yes, China is leading on the electric vehicle scene, but it is also fair to say that the sales of vehicles with internal combustion engines is still on the rise as well. So Chinese vehicle sales growth is going up, and the capacity is there also. I mean, famously, late last year, early this year, there were, I think, 2 instances where there were, let's just call them price wars internally, where car retailers were discounting their brands just to shift their inventory of vehicles into a slightly more sluggish consumer space in China. So back to your question, yes, I mean, the pace of transition in China is very much in Chinese interests. China doesn't produce all that much oil and gas of its own. It is a substantial producer, but by their standards, it's not enough. There's a huge import dependency, and it's just common sense to help with the balance of payments to electrify faster, because electricity can be generated via renewables and, of course, via the vast coal resource that China also enjoys.
Let's go to the survey.
As EVs from China grow, they're fed with coal. And as the Biden and the European Union administration trying to reach their own energy targets, they have to interfere more into trade restrictions, making environmentalists side with economists and saying this can't really work. There's two
on
things
that point,
really
Christoph, any takeaways, Christoph, from the Chinese president's visit to Europe last week? I mean, some of these issues are fairly front and center. Cold War on the way.
Yeah, I think it was an attempt to drive a wedge within Europe with the longer term extension of somehow then maybe courting the European Union on one side and drive a wedge between the US and the European Union. It's pretty obvious. And China seems to have made up his mind also that those Europeans who support the Russian war are closer to themselves. So they seem to be a much not less hesitant of talking about what Russia is doing in the longer term in their relationship to Russia than they have been in 22. So all moving in the wrong direction, including, of course, what's happening in the US, no matter who wins the election.
Let's go to the survey question and change the conversation to supply. Iraq has said over the weekend that it won't agree to roll over OPEC plus cuts for the second half. What impact would official announcement to end voluntary oil cuts have on prices? Not just some throwaway comment on the sideline of a conference, which is what this was by the Iraqi oil minister, but what would official announcement to end voluntary oil cuts have on prices? No impact. Prices would fall up to $3 on such an announcement. Prices would fall $5 or more, or prices could even rise because you would see a big reduction in idle capacity, which of course is a buffer for the market, and as you get lower idle capacity, then you get more concerns about possible supply disruptions. So what is your thoughts on the answer to that question? On an official announcement of an unraveling of these cuts, what would happen? Mike, of course, we might see some indication of that tomorrow when the markets open after seeing those Iraqi comments. Your thoughts on where the balance is for the second half, and does OPEC Plus have the luxury of starting to unravel these cuts?
The market has always felt that OPEC Plus, but Saudi in particular, would have the luxury of a market that was going to call for extra production, and therefore there was a possible scenario where an easing of the voluntary Saudi cut was possible. However, I think now that your participants have had enough time to vote, I didn't want to spoil the question by butting in any earlier, but we have to be very careful with the reporting of the comments by Hayyan Abdul Ghani, the Iraqi oil minister, because whilst he did say we've produced output enough and will not agree to any new cuts, what he did not say, I don't think, is whether he was opposed to an extension of the voluntary cuts that are in place. I think the smart money in trading circles will assume he did not mean to say he was going to depart from the group and start opening the taps. Far from it. I think that would be a move that wouldn't just make him unpopular with his peers, but I think it almost goes without saying that should OPEC Plus see fit to maintain and roll over, I think that's the expectation of Iraq. So I mean, the statement, I'm just looking it up here myself here because it's on the sidelines of a conference in Baghdad. What he said was they will not agree to any new cut, but I think by that you can drive a bus through the interpretations. But my interpretation of it is further cuts are off the table. He thinks that the market is sufficiently balanced for them to just continue. That was my interpretation of it. Now, as for yeah, go on, Christoph.
No, I was just going to follow up on that, Mike, because we did have Amina Bakker from Energy Intelligence on the podcast on Friday, and she's typically quite close to the Saudi thinking. And she made the comment that the traders are getting it wrong by expecting this rollover to happen on June 1st. The traders are getting it wrong by softening the market in anticipation of this official announcement of rolling over. It sounded very Prince Abdulaziz-esque in what she was saying and sort of scolding the market a bit. I'm just wondering, from your point of view, is there a holding pattern at the moment for this next big announcement? Your thoughts on that and its impact on the market?
I think it's very different for the market to be in the low 80s than the low 90s. And I think we have to acknowledge that Saudi has been doing most of the heavy lifting to give the market the stability, the term they prefer to use, that the market has seen and enjoyed. So it's really only appropriate for the Saudis to be making statements on possible adding back of production or abandonment of the current status quo. I mean, they are the ones that deserve to be making that call, and one assumes behind closed doors, having discussions in the plenary. But it all comes back to the second part of your question you put to me before, which is what's the outlook for Q3 and Q4 in terms of demand-supply balances. And as I said at the very beginning, those equations have softened somewhat on the demand side, and therefore give OPEC Plus pause for thoughts in terms of any thinking they might have had to start easing more volume into the market, which the consensus was in the 90s they might do so in order to avoid a spiraling of prices. I mean, it's only a few weeks ago that there were still people calling for $100 oil and then saying how much that might not work with Joe Biden's playbook of getting re-elected. So, I mean, that's the sort of mindset change that we've had. The market is decidedly softer than it was a month and a half ago. And therefore, I think that will play on people's minds as they approach during the first meeting.
Christoph, your thoughts on that?
Well, first of all, I think it's not Iraq. The real fault line within OPEC is between Saudi Arabia and the UAE. And the real important piece of news is not the sidelines of a conference here, but what the UAE has announced about the official increase in its production capacity. So it's still open how to resolve that, because in percentage term, the UAE is carrying the highest burden of the costs, not Saudi Arabia. Secondly, I think if you talk about OPEC Plus, why should Saudi Arabia be the only appropriate player to make a statement? Why not Russia as well? That fault line is also waiting for it, because Russia always continues to announce that they cut here and cut there, but it's not visible in the data, just the opposite. So I think against a background of potentially stabilizing but slowing global demand and growth, economic growth, and against the background of too much oil on the supply side, what we will see at some point, something has to give, and the likely scenario would be the Saudis or somebody else using the spare capacity they have for punishment. At some point, we might see a quite rapid sort of what we saw in 2020. So I'll show you what we can do, measure to discipline the parts. Or there has to be really a bargain in the triangle between Saudi Arabia, the UAE, and Russia, of which none of us will be part. And so it's it's hard to speculate about it, or not very useful to speculate about it.
Mike, are we seeing any space where the call on OPEC plus supply in the second half might grow because of stricter implementation of sanctions on Iran, on Venezuela, on Russia, the sort of tightening grip on the dark fleet and that sort of thing, so that this sort of supply that has been getting to the market in ample amounts over the last year, that might start to be restricted, and so there could be some wiggle room for OPEC plus in a weakening demand environment?
Very good question, Sean. But we've seen this play out for multiple quarters now, and it would appear to be in a relative state of stability. I mean, the volumes of Iranian oil that are finding their way to primarily Asian markets seem to be relatively constant. On Venezuela, we're on an extension now to General License 44. But what lies beyond is telling. There's plenty of lobbying going on in Washington for people to get exemptions. But as I've said on this show before, if GL 44 were to lapse, the oil probably still continues to flow, simply to different marketplaces, principally more to China and less to those other markets that have been taking Venezuelan oil in this GL 44 period, which are principally India and European markets. And then back to Russia itself. I mean, I think we've now had a protracted 2+ year period of dealing with this. You mentioned dark fleet. We know about the price cap. There are very well established channels whereby that oil flows on the crude side to India and China, on the product side to those markets that are taking it. In some cases with the price cap being observed, and in some cases there are channels that manage to find ways of getting around the G7 limitations. So I can't see what would change in the coming month to alter the supply-demand balance in OPEC Plus's favor in any way. But I guess never say never, right? These are political decisions and interventions that would be led by a certain government.
Well, the important thing is what has changed here, and this is that the oil market really has become a lot more of a government's play and really has become a lot more politicized with all these sanctions involved. And there we have one more factor to think about, and that's the US election. The US current administration will do what it can to keep oil prices where they are. And the friends, or the potential friends, or the hope for the next administration, a different administration, might be very tempted to bring oil prices up a little bit in the summer, in the driving season before the elections. You know, that's something which probably always was there as wishful thinking, but now it's there also with a lot more less influence of private sector movements and more influence of government-directed ways in which the oil flows and how it is priced.
Christoph, just a last word to you. I wanted to get your thoughts on it was an article in the Digest today, but it's something I've been thinking about a bit, is the volatility that's coming into the Fed transparency, the idea that the Fed's sort of micro guiding the market. This is what we think this week. This is what we think this day. And there's this constant speculation as to where the cuts, the easing are or are not coming, and the volatility that's creating in the market. Is that an issue for you? What are your thoughts on that?
Yes, that is an issue. So there's two things going on. One is this kind of forward guidance, this reliance on expectations, what they call the anchoring of inflation expectations, not to lose that. And of course, the longer you're in the gray zone and you see the data is coming in, it's unreliable, it's reversed. You know, people say, oh, there's 4 cuts, no, there's 3 cuts, no, there's 5 cuts, no. You know, the longer you're in this volatility, the harder it becomes to manage expectations, and the clearer it becomes so that the king has no clothes on when you only rely on expectations. The other side is that all of this really assumes that a very direct transmission mechanism from interest rates to economic performance, and the signal from the economic performance to interest rates to be very clear. It seems people have forgotten all the things which were discussed in the 80s, 90s, and so under the header of monetarism, that the money supply also matters. And we have fiscal policy and we have national debt, not only in the US, but in particular in the US, which is sky high and ultra loose. And we discuss inflation only in terms of sort of incremental ups and downs of interest rates. That's not good enough, because I don't think that with that kind of approach one gets to a durable 2% inflation target. And one loses managing the credibility, if one loses managing the expectations, then this whole model of forward guidance goes out of the window, and it's hard to see how it can be replaced. Interestingly enough, the person who makes this point all the time is Mervyn King, the ex-governor of the Bank of England, but none of the present guys touches the issue. That's a worry.
We're going to have to wrap it up there. As we say, Brent crude oil on a declining wicket last week, and in recent weeks since the peak above 90 in early April. Iraq says it won't agree to roll over. As Mike says accurately, we need to get the flesh on that comment. But what impact would an official announcement have? Prices falling up to $3 if that was officially announced, even above $5. We'll post that on social to see what comes of that. Obviously, some turbulence ahead as OPEC navigates its way to its big June 1st meeting and as expectations grow on that. Mike Muller, head of Vitol in Asia, thank you so much as always, Mike. Have a great month. Christoph Ruhl, Senior Research Scholar, Center on Global Energy Policy at Columbia University, which has become very famous in recent weeks for all of different reasons, including my son being there at the moment as a student. So that's a whole nother story. Thank you, guys. Take care. We'll talk to you soon. All the best.
Sure.